Welcome to our financial education series, where we'll be reading the brutal truth of quarterly results. Today, we're doing a deep dive analysis on Kaynes Technology India Limited's Q4 FY26 results. First, an important disclaimer. I am not a registered financial analyst. This video is for educational purposes only. Please consult a professional financial advisor before making any investment decisions. Starting with the top line, Kaynes is showing strong growth momentum. Q4 revenue increased by 26% year-over-year to 1,243 crore rupees, and full-year revenue grew by 33%. The order book also remains robust, suggesting strong visibility for the future. The bottom line, however, reveals a profitability miss. Despite 26% more sales, net profit fell by 21%, dropping from 116 crore rupees to 91 crore rupees. This decoupling of revenue and profit is a major warning sign for investors. Reading between the lines, EBITDA margins shrunk from 17.1% to 15.6%. This growth tax is due to a shift to lower-margin product mix, high execution costs for scaling up new facilities, and increased pricing pressure in the EMS sector. A closer cost analysis reveals the, quote, profit eaters. Depreciation, finance costs, and employee expenses have all seen increases of 95% to 178%. This is due to Kaynes building massive capacity, leading to high non-operational costs before the new plants generate significant cash. Kaynes' future bet is the semiconductor pivot, moving into chip packaging, or OSAT, and high-end PCB manufacturing. This is a high-margin business long-term, but currently requires massive short-term cash burn as they scale facilities like the one in Sanand. The operational red flags highlight the brutal truth. Kaynes missed its guidance by 20%, has a negative operating cash flow of 4.6 billion rupees, and working capital is stretched to 137 days. Remember, the market loves growth but hates execution delays and cash burn. Monitoring the QIP funds shows where the 3,000 crore rupees went. Debt repayment, funding inorganic growth through acquisitions like August Electronics, and general corporate expenses higher than estimated for compliance. In summary, the balanced scorecard shows positives like a strong top line and strategic entry into semiconductors. However, the negatives include the massive guidance miss, rising debt and depreciation burden, and severe working capital pressure. The verdict is that Kaynes is a show-me stock. It's in a growth tax phase as it repositions to an integrated manufacturer. Investors should wait for margin stabilization before entry, as management credibility is tested after the revenue miss. Use these tools to form your own opinion on your next investment. Specifically, check the cash flow, interest coverage, and guidance accuracy. Thank you for watching.